Hello everybody and welcome to this very first scheduled class on finance for non-financial professionals. My name's Adam and I'm one of the directors here. I won't take up too much of your time and I'll let Taryn get on with teaching the class very soon. But first I just wanted to take a minute to explain how this new format works and why we are testing this concept. Online learning suffers from a major problem. That problem is engagement and completion rates. The majority of online course takers start a course with the best intention in the world, get so far and don't end up completing. It's very similar to the way gyms work. Lots of people start to go, often in January, and then slip back into their old routine of watching Netflix in the evening instead. And I definitely count myself as one of that group. Guilty as charged. So engagement is an industry-wide issue, and as educators, it's our job to do something about that. Massive open online course providers, or MOOCs, like Coursera and edX, have made big strides in that direction. They schedule access to their online courses, typically starting them at the beginning of an academic term, and support them with webinars, peer review, and sometimes tutor support. We think we can do better as well. We want to give our learners a more interactive experience, more opportunities to ask questions, and a better chance of seeing a course through. And that's why we're testing this concept of a scheduled class. So, importantly, how does it work? If you haven't read this in the email yet, in university or college terms, think of Taryn, who'll be on in a moment, as your lecturer or tutor. Each week, she'll be leading an hour-long live session at this time every Tuesday. In each session, she will cover a different section of the Finance for Non-Finance Professionals course, and this will last for 5 weeks. So this is one of 5. We go all the way to the end of May. All live sessions will be recorded and emailed to you within 48 hours if you miss one, and she won't cover everything in the course. So Taryn will advise which part of the Finance for Non-Financial Professionals course you need to study in your own time. So be aware of that. We'll also try and include those details in the email that we send out to you guys. Any questions you have during self-study, you can ask Taryn at the next live session, or you can send the question in to us. That's info@webinarsteam.com. And we'll send that email around as well, so you all have that. Or there will be a Q&A at the end of each session as well, so you can always ask your questions then. As usual, if you've been in these sessions before, you can type them in at any time, and one of the team here will pick them up and ask Taryn as we go along. There is an online multiple choice test that you can take at the end of this course. This is accessible from your dashboard and will give you an IQ score for Finance for Non-Financial Professionals. And that will also tell you what level you're working to, and also gives you a downloadable certificate that you can add to your LinkedIn or onto your resume or CV. This course is CPD UK accredited, meaning that if you're required to collect CPD hours as part of your professional status, you can use the certificate of attainment as evidence you've completed this course. And again, that could be downloaded from your dashboard. This course has a filter, so the online element, that means you can personalize it before you start. So all you got to do is answer a set of questions, and if you have any prior knowledge in that area, what we'll do is we'll take out those non-relevant areas and focus your learning on the bits of the course that we think you really need to focus on. Again, you can access that from your dashboard. And if for any reason you don't have access to the online version of the course, do let us know. Just drop us an email on info@webinarsteam.com or pop a message into the message box and we'll be able to sort that out. So the final word for me before I hand over is we need your feedback. This is a really important part of the process. We want to know whether you like the new format. We also want to know if you don't like it and where we can improve. Be honest and candid, and it will help us decide whether we launch this as a product across multiple subjects or whether we head back to the drawing board to make it better. We'll be sending a survey at the end of the 5 weeks and would really appreciate you taking 5 minutes to fill it in. But to start off with, we're actually going to put a quick poll question up. So that should be coming onto your screen any second now. And we'll start with this one. What form of learning do you find most effective? Just click on the actual answers on the screen to answer, and we'll take your results. As you're doing that, I will end there, and I will pass over to Taryn, who's going to get us kicked off with the course and hopefully feedback on some of those poll results as they come in.
Great, thanks Adam. Thanks for the introduction. Hi everybody, I'm actually sitting in Cape Town in South Africa. I don't know if we've got any fellow South Africans in the audience, but it is early evening here and it's been a wonderful day. And I'm really excited to be able to teach you and guide you through this journey in finance for non-finance professionals. So without further ado, let's get kicked off. Adam, I think I'm having a bit of trouble. Oh, there we go. Switching slides, no problem. I think it was because the poll was still open on my side. Okay, just a really quick bit of background on me. I have studied and worked in both the UK and in South Africa. I do a lot of teaching for the University of Cape Town. I have a master's degree in commerce, specializing in finance. But I think importantly, I am not just an academic. I've got quite a lot of practitioner knowledge, and so I understand what it's like to be in a business, both in a corporate environment and in a startup environment, and what kind of base and what sort of information and tools are really useful in understanding and getting to grips with the financial elements of business. So this course doesn't have as an objective to turn you into accountants. So nobody should come away from this feeling like, oh my goodness, you know, I need to pass board exams or anything like that. What this really intends to do is to equip you with those skills so that you can participate in the financial business decision making within your current employment environment, or, and I hope this is the case, maybe there's some aspirant entrepreneurs in the audience who would really like to go and leave where they are and leave the kind of corporate world or corporate environment and start something. But in order to do so, realize that they need to round out their skill set and have some of those financial skills as well. Accounting, and we'll get to this in a bit, is a language all by itself, and quite often when we don't come from an accounting or finance background, we find the language of accounting really daunting, and sometimes that can prevent us from actually participating in discussions about business finance or about accounting because we just don't have the right words to use. But the financial piece of the business decision-making process is really important, because in order to make good business decisions, you need information, and that information needs to be relevant and it needs to be timely. It's no good getting information from 2 years ago and trying to apply that to kind of a day-to-day operation. So irrespective of what type of business you're in, whether you're in a large corporate and you're just one sort of piece of a big division within a corporate, or whether you're in a smaller business where there's just a kind of a team of you and you all multitask and everybody makes the coffee and does the printing and fixes the phones, or as I say, whether you have this kind of aspiration to step away from a corporate environment and do something entrepreneurial, or actually if you're in some sort of charitable environment, you perhaps work for an NGO, irrespective of the nature of your business, understanding the finances and keeping track of the finances and being able to make good business decisions on the back of financial information is really key. And what we find is that management financial decision making sort of falls into two categories. It can either be the making of strategic decisions or the making of operational decisions. Now, strategic decisions are really what the broad goals for the business entail. So if we're a business, we want to set out where we want to be in the next year, 2 years, 3 years. What is our grand plan? It can be tactical, so it can be, this is our grand plan, but in the shorter term, we're going to take advantage of this opportunity. So that's very much sort of managerial level overarching decision making that falls under that strategic banner. But then on a day-to-day basis, we've got to make operational decisions. So we may have a broad goal of where we want to take our business, but day-to-day we've got to run things. And those operational decisions involve planning. What are we going to do tomorrow? How are we going to spend the money that we've got? Controlling. So are we making sure that we're keeping track of all our finances? Are we making sure that we don't have a sales rep with a company credit card that's gone on a wild spending spree? Are we motivating our staff to understand why controlling costs, to understand why controlling and focusing on profitability of the business is important? Because quite often our staff that are under our control, if they're engaged and brought into that financial process, they better understand why it's important that they do keep track of their expenses, or why customer service is important because it's going to lead to more repeat business, which leads to more revenue for the company. So these are all operational decisions that we make, and of course we need to organize all of these business functions. So this is what we do on a day-to-day basis that support the strategic business decision making that we've put in place. So let's have a look at what financial information actually means. In order for financial information to allow us to make good and useful business decisions, that information needs to be relevant, reliable, comparable, understandable, and material. So let's just have a look at what those things might mean. So if it needs to be relevant, what it means is that if our business is focused on, let's say, selling t-shirts as an example, and we've got information on our t-shirt sales and how much our t-shirt production is costing us, then information on what we spent on the person that came to clean our offices is probably not relevant to our business. You know, it's information that, yes, it's an expense, it has to be taken into account, but are we going to make business decision-making steps and decisions based on our cleaning budget? Probably not. So it's got to be relevant to our business. It's got to be reliable. And what this really means is that the information has got to come from a source that can be factually backed up. So this can't be a sales rep coming to you and saying, don't worry, you know, I've seen 25 customers over this week and 15 of them are definitely going to convert into sales. Is that reliable information? Perhaps not. If, however, we had a diary log and we could see exactly how many meetings the sales rep had taken, and we had some knowledge on our conversion rates of sales meetings leading to actual business, then that becomes a more reliable piece of information. When we talk about information that needs to be comparable, this is quite often means comparing from one period to the next. And when we talk about periods in accounting, we're really talking about a date range. So we need to be able to compare information from 1 month to the next, from 1 quarter to the next, or even from 1 year to the next. When it comes to understandable, I think this is a failing of a lot of people in finance, that the metrics and the information they present is not actually understandable, and it actually prevents a lot of employees in the organization from engaging properly. So the real challenge and the real task of those that are in the finance department is to make this information accessible so that everybody gets what it is that's trying to be described. When we talk about material, this is actually an accounting concept, this concept of materiality. And what this really means is that if I'm a business and I've got £10 million worth of revenue, so turnover of sales each year, am I that concerned down to the kind of £20 mark? Probably not. Am I even concerned down to the £20,000 mark on £10 million worth of sales? Probably not. So not that that information gets thrown by the wayside, but when we're assessing the financial information with the intent of making good business decision making, steps, we need to understand that getting lost in the weeds can be detrimental to that process. So is this material? Does it actually add value? Is it actually meaningful in the grand scheme of things? So why do we undertake an accounting process? So other than keeping track of the profitability just for our own interest, what accounting allows us to do is to have the business financial health evaluated by what are external interested parties. So what do I mean by interested parties? So within a business, quite clearly the management of the company are going to be interested in the financial information. They want to make sure that they're running a profitable business. But in addition to that, financial statements provide the standardized way, standardized reporting for external parties, banks, investment analysts, your tax authority, shareholders that may not be operational in the business, prospective partners, perhaps another company that wants to do a joint venture with you. It's a way for them on a standardized basis to assess the financial health of your business. And while around the world we have slightly different accounting conventions, by and large, if you are looking at a pack of annual financial statements, if you're looking at American statements, UK statements, Canadian statements, Australian statements, European statements, they are going to reflect the same information. So when you look at an income statement, and we'll look at what that means in a bit, and it says a sales number or a revenue number, you know that that incorporates every sale that that business has made over a particular period. And it doesn't matter if we're looking at American sales or UK sales, it's telling you the same information. The profit is worked out in the same way. It's telling you the same information. So it's the standard way so that we can compare like with like, and when I pick up a pack of financial statements, I kind of know what I'm getting. So that's why we undertake an accounting exercise. Yes, to keep track of the business, but also as a way of being able to communicate the financial health of the business to all sorts of interested parties. We have two different streams when it comes to finance and accounting information. We have financial accounting, and then we have management accounting. And they're sort of the same but different, if you like. Financial accounting is typically prepared for external parties. Yes, the management of the company will look at those, and that is important, but it's this standardized report pack. And an annual financial statement comprises of three primary reports. It comprises of an income statement, a balance sheet, which sometimes we call a statement of financial position, and a cash flow statement. There is also a fourth statement, which is a statement of changes in equity, but that's less important unless you are a big publicly listed company. Those financial statements must comply with accounting standards in whatever jurisdiction you're in, and more generally with what is called GAAP, the globally accepted accounting practices. So they've got to be produced in a standardized way. They have to be produced at least annually, but if you're a listed organization, quite often there is a requirement to produce those on a quarterly basis. That financial accounting pack reflects the past performance of the company. So it's not forward-looking, it's showing us what has happened. And again, dependent on your jurisdiction and dependent on the nature of the legal entity of your business, those statements may need to be audited, which means an auditing firm comes through and checks your financial record keeping to ensure that that accounting pack has been produced in compliance with the accounting standards, and the auditor would then sign off on those annual financial statements. So this is a historic reporting of how the business has performed, very much a standard format, and used typically by the outside world. Management accounting, on the other hand, is really tailored for the internal participants in the business. So the people that are operationally involved, that are making the day-to-day decisions, be they operational or strategic. Management account, so it's much more frequent than perhaps an annual financial statement. And in fact, if you were a very high turnover business, so let's say you processed a lot of transactions each day, maybe you would actually have a daily budget or even a weekly budget. So the management accounting is tailored to suit the company's internal requirements. And while in a financial statement pack, in a financial account, you don't want the outside world to know about. So these are things that we're planning, new initiatives that we're planning, new products that we may be bringing on stream, new concepts that we're testing. Those kind of things we may not want the outside world to know because our competitors may get a hold of those as well. So management accounting may include information that is for internal use only. And it may also include measures of our production and our efficiency as well. The difference between a budget and sort of monthly management accounts is that a budget is very much forward-looking. It hasn't happened yet. This is what we expect to have happen in the future. So there is this sort of two streams, if you like, of accounting. And what you find is that people specialize in either being financial accountants or specialize in being management accountants, sometimes also called cost accountants. And those are the two sort of avenues that you can go down. So as I said right up front, finance and accounting are very jargon heavy and they have this language of their own. And quite often if we don't understand the terms being used, then it's very difficult to have a conversation with the finance department. It may sound like they're speaking another language, and quite often that can be intimidating. We don't want to get involved because we're not sure about what we're saying and we don't want to be shown that we don't understand these concepts. So when it comes to financial accounting, we've got these three really sort of key categories that are really important to understand. And these three key categories are assets, liabilities, and equity, and dependent on where you are in the world, may be called capital. So what is an asset? Well, an asset is a resource that the business owns that's used in the production of income. It may be short-term or long-term, and may be tangible or intangible. So what do those words actually mean? So if it's a tangible asset, it means something that you can literally see and touch. It may be a building that the business owns. It may be a piece of equipment. It may be a delivery vehicle. Those are all tangible assets. We can see them. An intangible asset may be something like a copyright or a trademark or a patent. So we own that. That is ours. It's our property. We use that patent to produce an income revenue generating stream. So it's used in the production of income, but we can't actually see it. Nobody can, aside from kind of the patent register, nobody can hold up a patent and say, this is what I own, in the same way that you could hold up your delivery vehicle and say, this belongs to me. So those are what assets are. And I think it's probably fairly easy to think of assets within the context of your business. We also always attach some sort of time frame to the assets. So I say that we could have long-term assets or short-term assets. And those time frames really give a sense of how quickly we can turn the asset into cash. So a long-term asset like a building, if we want to sell our building and raise the cash, it's going to take us a while. Okay, a delivery vehicle may be turned into cash more quickly, but it also gives us a sense of the time frame over which we use the asset to produce income. So a piece of equipment we may use for 5 years, even 10 years to produce income. So it is a long-term asset. A short-term asset tends to be liquid, which means can be converted to cash easily, and tends to be less than 12 months in duration. And we'll have a look at some examples of short-term assets in a bit. The sort of converse of an asset, if you like, is a liability. Now, a liability is an obligation of the business. These are amounts owed to external parties. And we all probably intuitively understand what a liability is. If we have a mortgage on a house, we know that we are liable to pay the bank every month for that mortgage. We owe the money. If we've borrowed money from a friend, we have to pay that back. We owe that money, we are liable for it, we have an obligation to repay. And again, we attach some sort of time horizon to our liabilities, and a long-term liability we would typically have to pay back in anywhere from kind of 1 to perhaps even 30 years, depending on the nature of the liability, whereas a short-term liability we typically have to pay back within a 12-month time horizon. And sort of the resulting sum of assets and liabilities, and this is known as the accounting equation, is equity. And we can refer to equity as capital, and it's really what is known as the value of the owner's interest in the business. So what does that actually mean? So if our business has got assets, so things that it owns, and it's got liabilities, amounts that it owes, the resultant of those two, if we subtract liabilities from our assets, our equity is what is left over. And this equity, I've got it here, equity minus equals assets minus liabilities. You can see that once we have settled all our liabilities from our assets, equity is what is left. And it's the business owners that have the stake in this equity. That is what they own. Sometimes when we talk about capital, it can also refer to the amount of cash invested into the business by the owners. And we talk about the process of capitalizing the business. But essentially, that is also creating an equity stake in the business. The owners have given the business some value, and that is what that equity is. So just give me a sec. I see my scribbles have stayed on screen as I've changed. There we go. All right, so we spoke about financial accounting statements, and we spoke about the fact that these are standardized documents that present a view of the health of the company. And we said we had three main documents. We had a balance sheet, an income statement, and a cash flow statement. Now, these are set out in a very specific and almost regimented way. So if I pick up a balance sheet from a company here in South Africa, or I pick up a balance sheet from a company in the US or in the UK, I'm going to find the same items on that balance sheet. Sometimes, dependent on industry, there will be industry-specific metrics, but as a general rule, I will find assets and I will find equity and liabilities on the balance sheet. And can you see, we spoke about the three principal categories that we break accounting information into. We break accounting information into assets, into equity, and into liabilities. And those three categories are what we present on a balance sheet. Now, a balance sheet is a sort of funny thing because it's a snapshot of the company on a particular date. So if our financial year end is, let's say, the 28th of February, then this will be what is our asset value on the 28th of February? What is our equity value on the 28th of February? What are our liabilities on the 28th of February? So it's as at a particular date and time. And this shows us all our assets, all our liabilities, and all our resulting equity. When it comes to an income statement, you'll see quite often the title or the header for an income statement says income statement for the period ended 28th of February 2017, because it is a cumulative of everything that has happened over that year, or if it's quarterly, over that quarter. So whereas a balance sheet is just a fixed date and time, an income statement shows you what has happened over the period. Now, an income statement, as the name suggests, has as its resultant sum our income or our profit. And an income statement, again, will be set out in a pretty specific way. It'll show us all the sales that we made. It'll show us what it cost us to sell those goods. And this resultant sum, in other words, revenue or sales, subtract cost of goods sold, gives us gross profit as a resultant sum. And then we're going to subtract all of our operating expenses. So these are all the things that we incur for being in business. So we may have to pay rent, if we've got staff, we would have to pay salaries and wages, we would have general admin costs, we would have utility costs, we would have bad debts, we would have depreciation, we'd have all of these things, and these are all classed as operating expenses within the business. So we've got to add up all our expenses, and that adds to, I've got a number here of 38,900. And what we do is then subtract our operating expenses from our gross profit to get a net operating profit. And accountants love to use the term net. It really just means the result of something, one item subtracted another item. So that means net. So that is our net operating profit, which really means our gross profit less or subtract all of our operating expenses. We would then have some sort of interest expense. And interest expense would be if we have some sort of interest-bearing liability. So think of this as a mortgage again. We know that when we pay our mortgage, we've got an interest portion that we're paying each month. So then we get our interest expense, and that gives us again a net profit before tax, which is our operating profit, subtract our interest expense, and then unescapably the world over we're going to pay some tax, and that will be dependent on what the corporate tax rate is in your operating jurisdiction, but we're going to have some sort of tax expense. And finally we get to a profit after tax for the period in which we've been operating. Now, how do the balance sheet and the income statement talk to each other? Well, what happens is that this profit after tax is an increase in equity in the business. We've created some additional value for the shareholders of the business. And what we do is we push that onto the balance sheet in the item called retained earnings. And retained earnings really says to us how much profit have we accumulated from being in business. So each year that we make a profit, and let's assume that we don't distribute all that profit, so the owners don't take that profit out of the business. Instead, we keep it in the business, we retain it in the business. Our retained earnings is increasing our equity. You can see on the balance sheet that we have some capital and some retained earnings, and together those come to our equity value. So retained earnings is sort of your cumulative profits over the years of operation, and together that gives us an equity value. What I want to show you as well on a balance sheet and balance is sort of the right word for it, that our asset figure, our total asset, which is made up of our non-current assets like property, like vehicles, like patents, which was an intangible asset, plus our current assets, and these are things that typically are much more liquid, so in other words, are much more cash-like and tend to only last within 12 months. The sum of our non-current assets and our current assets gives us a total assets figure. And what we see is that our total assets is equal to our equities plus our liabilities. And if we think back to our accounting equation, which we had on the slide before, and I'm going to test everybody's algebra now, we said that our equity was equal to our assets minus our liabilities because it was the net claim of the owners on the business. But what I can do is a little bit of algebra. So sorry for those of you that last did algebra a long time ago. But if you remember, we can actually write the accounting equation as equity plus liabilities equals assets. And really, that's what a balance sheet is showing us. There's our assets, sums together to give 217,000. There is our equity and our liabilities, sums together to give 217,000. So our balance sheet balances, and it gives us a good snapshot of where the business is at on the balance sheet date. One last thing before I scribble all over this slide is that I've marked a few items with a little red X there because I just want to highlight a term called working capital, which quite often comes up. And working capital is what is called the current portion of the balance sheet. It's the current assets on the balance sheet, and it's also the current liabilities on the balance sheet. And sorry, overdraft should also have a little red X there. That seemed to have fallen off. All right, so that's what a standard view of our balance sheet and our income statement will tell us. And let me just erase all my scribbles and we can move on to the next slide. Now, the final key statement within our financial accounting statement pack is a cash flow statement. Now, a cash flow statement, as the name suggests, deals with cash only. And dependent on the nature of your business, you may have a situation where you sell some of your goods on credit. So what does that mean? It means a customer comes into your store, buys your t-shirt, but doesn't pay you straight away. They owe you the money. And that is what is called an accounts receivable. You are still to receive the money, or another word for it is a debtor. And that is an asset on our balance sheet, and we saw it in the current assets section. But now we've made the sale, but not yet collected the cash, which means that on our cash flow statement, we can't show that as cash being received from our customers. When they pay us, and that may be a month or 2 months or 3 months down the line, then we have received the cash and we show it on our cash flow statement. The important reason for conducting a cash flow statement exercise in addition to an income statement exercise is that we can be in this really strange situation where we've made lots of sales, but they're all on credit to our customers, so we haven't yet collected the money, and we show that we're profitable because we've made all these sales, but actually we haven't collected any cash, and we end up having a kind of cash flow crunch. We run out of actual cash within the business. So the cash flow statement gives us an indication of whether our sales and our investing activities and our financing activities are actually resulting in cash, physical cash, in our bank account. Because we can have this situation where the business looks profitable but runs out of cash. And we'll deal with that a little bit later in the course. So essentially a cash flow statement has these 3 segments to it. we have cash from operating activities, which is our kind of day-to-day business activities. Our business may invest, and so we have cash flows from investing activities, which may be to buy a new delivery vehicle. So that would be a big cash outflow in the year. Or we may sell a piece of equipment that we no longer need, and so we receive that cash in, and that's from our investing activities. We may actually, as a business, also buy a stake in another business, and we would then be investing in another business. We also have cash inflows and outflows from financing activities. So this is when we are bringing capital or financing into the business. And so we may have received a loan from the bank and that cash flows in, and that would be classed as financing activities. And what we're really trying to see is the sum of our kind of cash inflows and cash outflows over the year. So sort of in summary, our balance sheet represents the financial position on a particular date. Our income statement shows all our revenue, all our expenses, and our resulting income over the period of operation. And our cash flow statement shows the movement of cash-only items. And we'll get on to what depreciation expense is a little bit later on. So those were some key financial accounting terms. But as we know, we've actually got financial accounting and management accounting as two sorts of separate branches of the same finance tree. When it comes to management accounting terms, we're now much more interested in some of the operational metrics of the business rather than sort of the broad end-of-year financial statements. So a key management accounting term is the selling price. Now, it doesn't matter if your selling price is for an actual good that you're selling. So let's go back to the t-shirt example. So we sell t-shirts at a particular price. So we have a price per t-shirt. Or if we sell our services at a particular price. Let's say we are a graphic designer and we design logos for business and we sell a logo design package at a particular price. So that would be the selling price of our services. And in order to work out our total revenue or our total sales, we've got to look at the selling price per unit. So in other words, the price that we put on our t-shirt or our logo design service, and multiply that by the number of t-shirts that we sell or the number of customers that we design logos for. And the product, the multiplication of those two things, gives us our total revenue. And we'll see why it's really important to keep track of that in management accounting. Then we have this concept called fixed costs. Now, fixed costs have to be paid irrespective of what we produce. So if we come back to our t-shirt example again, if we sell one t-shirt or 1,000 t-shirts, but we have to pay the rent on our factory every month, we pay that rent irrespective of how many t-shirts we sell, irrespective of whether we sell one t-shirt or 1,000 t-shirts. We must pay those fixed costs. And those are typically things like our rent, like our management salaries, like our insurance bill. There's no escaping them. We have to incur them each month that we're in operation. Then we have something called variable costs. And these costs vary, hence the name, with the volume or the amount of our production. So looking at our t-shirt example again, perhaps some of our inputs to producing our t-shirt is our fabric, perhaps it's ink for the printing of the design on the t-shirt. If we produce one t-shirt, then we have one t-shirt's worth of raw material cost. If we produce 1,000 t-shirts, then we have 1,000 t-shirts worth of raw material costs. So those variable costs change with the volume or the amount of our production. Fixed costs, like the name says, they are fixed. Doesn't matter how many logos we design or t-shirts we sell, we have to pay those costs. Variable costs will change with the volume or the amount of production. Some other key management accounting terms, and these pertain more to a production environment than a services environment, but there is some degree of overlap. If we are producing a t-shirt, the direct costs are those that we can easily identify with that t-shirt. So we could easily identify the amount of material, fabric, that is associated with that t-shirt. We could easily identify how many labor hours went into sewing that t-shirt. Could we easily identify the cleaning bill on our factory with that t-shirt? Probably not. So that would be an indirect cost. So it's part of the production, and maybe it would be maintenance on our sewing machines. So we have to incur it as part of our production process, but we can't really attribute it to any one unit of production. So direct costs are typically the direct materials, so the raw materials that we put into our product, and the amount of labor that goes into making our product. If we think of a really big production process, let's say the manufacture of a car, which has all sorts of steps to it and is a complicated mechanized process that we would go through, we would likely be very easily able to track the amount of metal that went into the chassis of the car. We would know exactly how much we needed, and that would be stamped and assembled and welded and all of those things. Would we be able to keep track of the amount of, let's say, lubricant that went into the engine design and manufacture process? It would be tricky. You know, somebody would use a lot, somebody would use a little. So that would be an indirect cost. We know we have to incur it in producing the engine for the car, but we can't really say each particular engine used a specific amount of the engine lubricant. So things like small little screws that you might use in the production process, we know that we're using them, but whether we attribute 10 screws or 20 screws, it's sort of immaterial in the production process. And that's the difference between direct costs and indirect costs. And then we've got this really key concept in management accounting, and it's called variance. And variance gives you the difference between the actual costs incurred and what we thought the costs would be. And we cover variance a lot later in the course. But it's just important to know that when we are dealing with management accounts, and particularly when we're dealing with a production process, we have an estimate, a budget, an expectation of what our costs might be. And then as we actually produce, we get actual costs. And we compare our actual costs to what we thought our budgeted costs would be. And the difference, the subtraction between those two, is called variance. We have some key business drivers. So we have to, as business decision makers, we have to keep an eye on our profits. Certainly, you wouldn't want to be in a business that was not profitable. Perhaps a startup business sort of budgets to be not profitable while they're gaining traction, while they're ramping up production, while they're scaling up. But we need to understand whether our sales are covering all our expenses and leaving us with a profit at the end of the day, because the profit is what is growing the value of the business, what is growing the value of the equity for the shareholders. As we mentioned earlier, we also have to keep track of cash flows. because we can have this funny situation where from an income statement point of view, our business looks profitable, but because we're not actually collecting the cash from our customers quickly enough, we can run into cash flow problems. And if we run out of cash and we owe people money and we don't have the cash to pay them, that can then be a very dangerous situation for a business to be in. So within our management accounts, we would likely on at least a monthly basis understand what our gross profit and likely what our net profit before tax figure is. We would also have to understand on likely a monthly basis how much cash has come in, how much cash has gone out, and we need to keep a track on those two items as key business drivers. The other elements of our business that really are under our control are our sales margins, and the term margin comes up a lot when we're dealing with finance. And a sales margin really means what is our selling price, subtract what the good cost us to make. And that difference is effectively our gross profit, and we can look at it as a percentage of our sales, and that gives us a sales margin. In a wholesale or production type environment, we may also refer to this as a markup, and we're probably as customers more familiar with markdowns when we go into a high street store and everything is on sale. It means they have marked down the selling price. But when we are doing the selling, we would have a cost of our good that either we've bought it at or we've produced it at, and we would mark it up. We would add a margin on that cost, and that's really what margin refers to. Within a business, something that really is under our control to a large degree are our costs. We can keep track of what we're spending on our production. We can keep track of our general operating expenses. So we can note whether our printing bill has become excessive and somebody is just pumping out their kids' birthday party flyers on a color printer, and we can stop that kind of behavior. We can also keep track of the fact that one of our sales reps seems to be doing a lot of client lunches, and we may want to have some standards and controls around those costs. And what we would also want to do is keep track of our working capital management, and working capital refers to those current portions on our balance sheet. Our inventory or our stock, our cash itself is all current assets. The customers who owe us money, who are called debtors or accounts receivable, those are all our current assets on our balance sheet. Our current liabilities, which form part of our working capital, are the suppliers that we typically owe money to. We sometimes call those payables or creditors or accounts payable. And we would need to understand the interplay between our current assets and our current liabilities to make sure that we have sufficient cash to finance our daily operations. Now, this isn't just an annual exercise that we need to go through. This is something that we need to do on a continuous basis to monitor these key financial indicators for our business to make sure that our business is operating efficiently and profitably. And that ends our first live session, and I'm hoping that there are some questions. And I know, as I said, this is a jargon-intensive subject, and what that means is that we've got to actually get familiar with a whole new language, and that can take time. So if you want to ask a question but you're not quite sure of the words that need to be used, don't worry about it. This is the opportunity to learn.
Hey there, Tarrant.
Hi, Adam.
Hey, how you doing? So we do have one question in from Lorna. It says, can you talk a little around CAPX, please?
Sure, Lorna. So CAPX is again, it's a jargon term, but it stands for capital expenditure. Now, capital expenditure is when we decide as a business to invest in new things, and typically it's when we're investing in long-term assets. So our CAPX expenditure would show up on our cash flow statement. It would show up in our cash outflows if we're buying capital equipment from investing activities. But there's another component to CAPEX. The business has got to finance that capital expenditure from somewhere. So if the business decides it wants to go and buy a new piece of equipment, so that's CAPEX, capital expenditure, where does it get the money to pay for that? Either the business has got sufficient cash stockpiles because it's been profitable over many years and has accumulated and retained a lot of income and can actually go and buy that piece of equipment outright. Or alternatively, it may have to take some sort of loan in order to buy that piece of equipment. And sometimes whoever supplies us with equipment provides us with financing, or we may need to go to the bank and say, we're a business, we want to buy this new piece of equipment because by having it, we're going to be able to expand our business and generate more sales and be more profitable. And at that point, the bank would say, great, show me your annual financial statements, typically for the last 3 years, because the bank wants to make sure that before they lend you the money to go and finance that piece of capital equipment, that you have sufficient cash reserves and are generating sufficient income to give the bank comfort that you will pay the interest on that loan, which would show up in your financing costs and would show up as an interest expense on your income statement, and ultimately to pay the loan back in full.
Great, thanks, Taryn. That's brilliant. We do have a few more questions that are now starting to flood in. First one: why in the cash flow did you add dividends paid? If that makes sense to you.
Yes, it does. What I'm going to do, Adam, is actually just go back to that cash flow statement.
Fantastic.
Oh, there it is. Okay. So when we pay dividends, let's maybe just tackle what that means, is that not all businesses pay dividends. There's some very famous businesses that have decided to never pay a dividend, but a dividend is really a portion of the profits paid to the shareholders. It's sort of like a little bonus for them, saying, you know, the business has been profitable, it's generated a lot of money, you as a shareholder are entitled to a share of that profit, and we will pay that in the form of a dividend. So quite often, if you invest in a share yourself as part of your kind of investment portfolio, or even if you have some sort of mutual fund, they will tend to pay dividends, and it's an income stream that comes to you. So when the company decides, and there will typically be a dividend policy in place, when the company decides to pay dividends, the cash actually leaves the company bank account and goes to its shareholders. And we mostly specify dividends as a dividends per share. We may have a situation where we as a company actually receive dividends. We may have invested in another business, and this quite often happens if you've got a holding company and a subsidiary, where the company receives dividends in, and so that's cash coming into the business. So it sort of depends on the direction of the dividend. Is the company paying the dividend out? So subtract it, it's an outflow from our cash statement, or are we receiving the dividend? Is it coming into our bank account?
Fantastic, Taryn, thanks for that. We just have one quick question from Louise, which I think will be pertinent to a lot of people. She asked about the homework for the next session, whether it will be emailed or on the dashboard, and if on the dashboard, will it be easy to find? Great question, Louise. the homework will actually be emailed around. Unfortunately, we're not advanced yet, technologically wise, to have it coming up on your dashboard. But to say, if we get this test up and running, then that's something we hope to integrate into the content management system. So we will email you which parts of the course go along with this this initial live session. Third question actually on the topic covered is, my company reports its quarterly financials via GAAP, GAAP, and non-GAAP. Can you summarize the difference, please, and why they would do this?
Yes, that is a great question. So that's, in my South African accent, I'm going to call it GAAP, and non-GAAP, which is generally accepted accounting practices. Dependent on the complexity of the business is where you start getting these real differences between GAAP and non-GAAP statements. And it has got a lot to do with how we treat quite often one-off items. So how we treat, let's say, the sale of a big piece of, let's assume that we're a mining organization, because that is very asset intensive. And assume that we sell one of our mines, which would generate a huge amount of cash flow coming in. Dependent on the nature of that transaction, GAAP may say you can't recognize that as revenue because it's not revenue, because it's not produced in your as a result of your normal business operations. It was a once-off. So in other words, you cannot show that in revenue, and if you can't show it in revenue, you don't see that coming into the profit statement. That's got to sit somewhere else. That's got to sit in your cash flow statement, and it's got to sit on your balance sheet. But from a non-GAAP perspective, and I'm just using this as a kind of a loose example, let's say we know that we're going to do this on a regular basis. And so we want to say, yes, GAAP, we understand that you don't want us to call this revenue, but we know internally that this should be revenue. So we want to classify this transaction as a revenue transaction, even though GAAP tells us we shouldn't. And so that would then start to lead to a difference in what the GAAP statements look like versus the non-GAAP statements. So often, and this is particularly true of public listed companies, they may often produce almost a dual pack of statements where they believe that the accounting treatment on a non-GAAP basis better reflects their business operations, but because they're public and they're listed, they have to comply with GAAP reporting, so they have to also produce GAAP statements. And then financial analysts go into a little frenzy to do an assessment between the GAAP and the non-GAAP, and it all can get quite complicated. But it's often to do with the classification of a particular transaction, whether we're calling it revenue or not, whether we're calling it recurring profits or not, whether we can deduct it from a tax point of view or not. That's where all these sort of really kind of gray areas come into being.
That's great, Taryn. Really comprehensive explanation there. And yeah, okay, great. We've got time for one final question before we close off for the evening, and that is from Mark, and it says, is contribution margin the same as gross margin?
Sort of, Mark. I'm saying sort of because when we talk about gross margin, we are really saying sales minus or subtract our cost of goods sold. Now, and that gives us a gross profit, and from that we can determine a gross margin. Now, cost of goods sold is very much an income statement concept, and we would show that on the income statement, and there's pretty standard things that we can and can't include in that cost of goods sold. When we talk about a contribution margin, that's a much more management accounting principle. And what we do when we determine a contribution margin is only subtract our variable costs from our selling price in order to get a contribution margin. So we spoke about the difference between fixed costs and variable costs. Our cost of goods sold may include some fixed costs as part of those goods, whereas a contribution margin is the resulting sum of our sales minus our variable costs only. There are no fixed costs in there, and that gives us a contribution margin. So it's sort of a difference between, if you like, financial accounting and management accounting.
Fantastic, thanks Taryn. That's brilliant, and unfortunately everybody, that's all we have time for today, though if you do have any follow-up questions, do send them in. The email address is info at webinarsteam.com. We'll pick up those questions, and what we will do is we'll probably start next week's session by answering those questions. So we'll get it kicked off with some interactivity and by answering any questions that you come across. So just to remind you, get an email from us tomorrow, hopefully, with all of the recording of this webinar and directions on which parts of the online course you need to try and complete by next week. Thank you so much for being part of this initial test. We'll see you all in a week, and thanks so much, Taryn, for a great opening session. And I know I, for one, am really looking forward to the next few weeks and becoming a finance for non-financial professional pro by the end of it. So thanks everybody. Have a great evening if you're in Europe. Enjoy your day if you are in the US, and we'll see you soon.
Thanks so much, Adam. Goodbye, everyone. See you next week.